Hello everyone, my name is Saikat Roy and I am welcome to this webinar which is being conducted by Clear Tax. During this webinar, we are going to learn about the taxation on long-term incentive plan, that is ESOPs, that has been issued by the employer. Now, before we go ahead with the webinar, a little bit of background of myself. I am a chartered accountant and I have been part of Clear for last 5 years. And I presently handle the internal tax team, and I have experience in income tax matters and international taxation. So without further ado, let's take a look at today's agenda. Right. Firstly, we are going to understand what constitutes an ESOP, right? How it is being taxed. After that, we are going to learn different types of taxation that can be associated with ESOP, right? So we are going to go through them and understand the tax implication of them. And finally, we are going to take a look if there are at all any tax saving opportunities on ESOPs. And finally, if there are any disclosure requirement in ESOPs. Now, first and foremost, let's try to understand what is an ESOP. Now, ESOP is an abbreviation. Normally, it stands for Employee Stock Option Plan, right? So, what it is actually, when you are working with an organization for a certain amount of time, the organization gifts you, or rather grants you, shares of that organization. Now they can issue the shares at a lesser amount of price or free of cost. That actually depends upon the compensation policy of the organization. Now the ESOP, granting of ESOP actually ties with certain condition, right? So while getting the ESOP, you may have to serve a certain period of time with the organization. Then only you will be able to get the ESOPs. So ESOPs actually work like a compensation that is paid to you because you have worked a certain period of time within the organization, or you are going to serve a certain period of time, so that after you serve that period of time, shares of the organization are issued to you either at a lesser price or free of cost. Normally, in India, the organizations, they issue shares of the company at a lesser amount of price, right? So, for example, if the market price of the share is coming to 100 rupees, you may be able to purchase those shares at a lesser amount, say 75 rupees or 80 rupees. Right now, this point is very crucial because it ties to one of the major component of taxation of ESOP. Now, if you are given shares at a lesser amount of price, that is prevailing in the fair market value, that means you are getting a benefit. How? Because if you went to open market and try to purchase the stock, you would have paid 100 rupees. Now the same share is being issued to you at a lesser amount of price, right? That is 80 rupees. So you are getting a benefit of 20 rupees. Now this benefit of 20 rupees becomes perquisite, and at the time of exercise, whatever the fair market value of the share was going on, and the amount that you are paying to exercise those shares, that becomes a perquisite. Now, once they become perquisite, they become taxable as salary in the hands of the employees, right? So this is how the perquisite is computed, right? And this is how the perquisite becomes taxable. Again, perquisite falls under the purview of salary. Therefore, all the taxation for it are paid through the payroll itself, right? Therefore, after you pay the money to the company, there is the tax on the perquisite value, that is the tax on the 20 rupees, will be collected from your payroll itself. Therefore, in the month of exercise, you could see a high amount of income tax being deducted. Why? Because the perquisite amount is being taxed in your hand. So this is how the ESOP at the time of exercise actually happens. Now, once you get the ESOPs, right? Once you get the ESOPs and they become your holding, you normally tend to get a dividend amount. Now, dividend is a fraction of the profit that is earned by the organization, right? So every shareholder in essence is the owner of the company, right? And being owner of the company gives you right to the profit the company has earned. Now the profit is distributed among the holders by way of dividend, right? So once you become holder of the share by way of ESOP, you become a fractional owner of the company, and in turn, you will get certain amount of profit of the company, right? Now, normally, when the dividend is earned, it gets paid to you. However, TDS implication is always there, right? So, if the dividend amount is more than 5,000 rupees, the organization shall deduct an amount of tax on the dividend distribution, right? Now, what happens is you need to disclose this dividend as your income from other sources in your income tax return. And similarly, whatever tax that has been deducted by the company on that dividend, that needs to be claimed as TDS in your income tax return. Dividend normally is taxable at the slab rates, right? So while computing your tax return, while computing your taxes and everything, please make sure to include this, right? All the details of dividend earning, whether tax has been deducted or not, all this information shall be available in either AIS or 26AS. So before filing your income tax return, take a look at 26AS and AIS, right? Excuse me. Now, there is a point that I have mentioned that if the dividend amount is not more than 5,000 rupees, in that case, TDS will not be deducted. Now, does it mean that if my income from dividend, if my dividend earning is not more than 5,000 rupees, I am not liable to pay the taxes? It simply does not imply that. If you are getting dividend, that will always be taxed. Just it is falling within the threshold limit, it is falling under the threshold limit of 5,000 rupees, tax will not be deducted. So if you are getting a dividend of 4,000 rupees, tax will not be deducted. However, the entire amount of 4,000 rupees shall need to be disclosed in your tax return as your income from other sources, right? Also, another thing you should be keeping in mind that in 26AS, you might see that the salary income and dividend income is clubbed together, right, under 26AS. So if you are working with company X, in that company X you are earning salary as well as dividend, you might see in 26AS there is one single entry, one entity name, and under which all the things are listed out, salary income as well as dividend income, right? So you need to be really very careful while claiming the TDS, because normally the organization have 110 against which all the tax deduction are presented, right? So salary TDS might be deducted under the same TAN, TDS on dividend might be deducted under the same TAN. So if you are getting dividend, just be very careful so that you are claiming the correct amount, right? It might take 1 minute or 2 minutes of your time extra, but be very judicious about it. Now, having understood, hopefully we have understood the concept of TDS on dividend and how to report it. Now let's talk about the capital gains. Now, capital gains is when you dispose of the shares that you have received under ESOP scheme of the company, right? Now, the capital gains, since the ESOPs are issued by a Indian entity, listed Indian entity, the taxability of those under capital gains for normal all the other shares shall be applicable on them, right? So the section 112A shall govern the disposal of shares of the ESOPs, right? Now, under this, let's talk about the holding period and how the capital gains is actually taxed. Now, depending on the holding period, capital gains will be calculated. Now, if you are holding the shares for a period not exceeding 12 months, right? In that case, the shares that you are holding will be treated as short-term asset, and any gain that you make on sale of those shares will be treated as short-term capital gains. If you hold them for 12 months or more, in that case, those assets will become long-term asset, right? And disposal on those long-term assets shall attract long-term capital gains, and in effect, it will attract long-term capital gains taxes. Now, since these shares are shares of India listed entity, right? They will not enjoy the benefit of indexation, right? Indexation benefit is something that actually takes care of inflation. However, this benefit is not available for Indian listed entities shares. What happens is, however, there is a different type of benefit allocated to capital gains of this nature, right? So what happens if you hold them for a period 12 months or more? In that case, firstly, we are going to calculate the capital gains. Then we are going to see whether the gain is more than 1 lakh rupees or not. If the gain is more than 1 lakh rupees, then the amount which is in excess of 1 lakh rupees shall be taxed at the special rate of 10%. If it is less than 1 lakh rupees, then no tax will be applicable. It will be made part of the total income computation without any doubt, but tax will not be computed. However, one point I would like to make is that if you have certain other shares as well and you are disposing them off and getting capital gains, right? These capital gains all together, this 1 lakh rupees benefit will be allocated, right? So, for example, you are holding the ESOPs of your parent, your company, that is company X. Along with that, you are holding shares of company Y, right? Now you are selling these two shares of, both of them are long-term capital gains. By selling of shares of company X, you have gotten a capital gains of 80 lakh rupees. By selling of shares of company Y, you have gotten a long-term capital gains of 70 lakh rupees, right? So together, your long-term capital gains is coming to 1,50,000 rupees. Now this 1 lakh rupees deduction will be given on the entire 1.5 lakh. It will never be allocated between these two in same quantity, right? So if you are under the impression from company X, I got 80 lakh rupees gain, so I will get the deduction of entire 80 lakhs. From company Y, I got a deduction of 70 lakhs. Therefore, I will get a deduction of 70 lakhs. This simply will not be happening. So we need to compute, we need to take both the capital gains together, apply the deduction, and then compute the capital gains. So in this scenario, your total capital gains by selling shares of company X and company Y is coming to 1.5 lakh rupees. After applying the deduction, your taxable capital gains will become 50,000 rupees. And on that, 10% long-term capital gains tax need to be paid, that is 5,000 rupees. Now on this 5,000 rupees, you are required to pay health and education cess at the rate of 4%. If you are liable to pay surcharge as well, then the surcharge will be applicable on it. However, the good thing is for long-term capital gains, surcharge is capped to 15%, right? For individuals opting for old regime, there are 4 surcharge rate. People opting under the new tax regime, they have 3 surcharge rate. But if you have capital gains, the surcharge rate will be capped at 15%, right? So this is one good thing you can consider. Now, tax saving. Now, tax saving can also happen once you get the capital gains. Now, capital gains tax saving is, or the capital gains exemption is given for only long-term capital asset. If you are selling of short-term capital asset, that is the shares you held for a period less than 12 months, they will not attract any exemption under any other clause, right? However, if you are holding them for a period in excess of 12 months, in that case, you can apply a exemption, right? However, the scope of the exemption is very, very limited as well. So you can take exemption under section 54F. Now, 54F simply says that if you are selling off any long-term asset other than house or piece of land, in that case, if you are investing the entire sum of money means entire sum of sale proceeds to acquire a building or construct a building, in that case the entire amount of capital gains will not be taxable in your hand. If you are applying a fraction of it or part of it, the entire sale proceeds, then the part of it which we need to calculate, that will be exempted from taxes. The exemption actually happens in this way. So total sale consideration, the capital gains divided by total sale consideration multiplied by cost of the new asset. So whatever the ratio that you get, the same ratio will be applicable for you. However, one point we need to remember, from this year onwards, under section 54F also has a capping limit. The capping limit is 10 CR, right? So if you are purchasing a flat or house which is worth more than 10 CR, in that case, the gain amount will be, exemption amount will be capped to 10 CR, right? Again, there is a little bit of calculation that goes on, but for the sake of time, we are not going to take it up. But be careful. If you are purchasing a flat or something, in that case, there is now a capping limit. Now, disclosure of ESOPs. Now, disclosure of ESOPs, normally we are not required to do. If you are opting or if you are filing the income tax return under income tax return 1, ITR 1, in that case, disclosure of ESOP may not be required, right? However, if you are filing ITR 2 and your income is more than 50 lakh rupees, total income is more than 50 lakh rupees, then you are supposed to give a declaration in the income tax return in Schedule AL, right? In Schedule AL, you are supposed to give a declaration of all the assets and liability that you hold. In there, you are also supposed to give disclosure of the shares that you're holding. The scope of disclosure is very limited, however, still it needs to be given, right? If you are a director of the company, then certain additional disclosure is required to be made in the income tax return as well, right? Information like the name of the company, the PAN of the company, the DIN number, etc., needs to be disclosed in the income tax return. Now, I hope you understood the nuances of tax on ESOPs, various parts of it, the tax that is imposed at the time of it getting issued, exercised, you are getting dividend, and at the time of selling them off. Now we are going to conclude this session. However, we have certain amount of time in our hand to address any question that you may have. If you have any question, please drop them off so that we can address them. Right. So I don't believe any questions are coming in. So I thank you all for joining with us. I hope you have understood that taxability of ESOPs when it is issued by your organization. So if you have any further queries, please let us know. And thanks for joining with us. Have a great weekend. Bye.